My view is that potential growth around the world has come down. It doesn't mean to say that there won't be any growth, or indeed that the US or globally we're heading straight to recession. I don't believe that. But I think we have to, as investors, accept that global growth will be lower, in common with lower inflation, and we have to set our investment expectations very much in line with that understanding. I think what we need is really more positive fiscal policy. Fiscal policy has not really been geared up to dealing with these problems. So on the one hand, we have an issue where global growth, not just in Europe, but global growth is really below its potential, so there's an output gap. And we need much more dynamic fiscal policy as well as continued loose monetary policy. And then secondly, what we need from a longer term perspective is economic reform. So structural economic reform to increase productivity and increase longer term growth. And at the moment, those reforms are not coming through. I believe that actually we're on the cusp of some changes. I think though in the short term we're unlikely to see any significant increase in the fiscal stimulus in Europe until after the German elections next year. And I think there's a growing understanding that perhaps the mandate of the European Central Bank is too tight. It's constraining monetary policy also in Europe. So I think we may start to see some changes there. In terms of economic reform, we're seeing certainly in places like Italy and France some improvement, but it's unfortunately at the moment it's too slow. So I think that's going to be the nature of this issue. Too slow, but nonetheless moving broadly in the right direction. I think for investors, they have to start to realize, in fact, that we're in this low growth, low inflation world for some time to come, maybe even permanently, and they have to adjust their expectations. But in reality, taking on a bit more risk than perhaps was previously the case, accepting perhaps less liquidity in certain instruments, if indeed you can hold them to maturity. These are ways of boosting your return, which can help from a portfolio point of view to deliver perhaps returns that are more in line with expectations, accepting that those returns on average will be lower than in the past.